Global markets remain mixed as US rate expectations shift, AI-driven tech volatility persists, domestic reforms boost sentiment. To help us understand what this means for the Indian equities, we have with us Mr. Harsha Upadhyaya, CIO Equity and Debt at Kotak Mahindra Asset Management Company Limited. Welcome to the show, sir.
Thank you.
So we know that Nifty has hit an all-time new high and it is up around 6.5% from September end closing. What do you think has driven this, and do you expect the momentum to continue in coming months as well?
Clearly, the undertone seems to be bullish for the last couple of months. I would say that this has been because of a couple of expectations in the market. One, from a global perspective, there is an expectation that possibly there will be a favorable trade deal between India and US in the near term. The second expectation is of a peace deal between Russia and Ukraine. So these two factors are adding to that bullish undertone. And from a fundamental perspective, clearly we may have seen the bottom of earnings cycle, and we will expect earnings to improve from here on, starting from second half of this financial year, well into financial year 27 and beyond. So these are the expectations which have actually led the markets to move to higher levels and show that bullish sentiment overall.
So with the Fed signaling caution at inflation, rate cut expectations, and AI-driven tech volatility in November, how do you think the global factors gonna shape the Indian equities?
Clearly, all the factors that you mentioned are negative for US economy or negative for US equity. And also, there is a concern about a possible weakness in US dollar. If any of these events pan out, then some of the global investors could look at investing outside US or maybe move away from US equities and move into emerging markets. That trend has started in a smaller fashion in the last couple of months, I would say. That could gain further momentum in case some of these expectations pan out the way that you mentioned. So to that extent, if that happens, the flow can come towards emerging markets, including India. And of course, India has not received much of foreign flows in the recent times for various reasons. We could be beneficiary of such a trend where US equities are kind of sold and emerging market equities are bought in.
So FIIs, after turning positive on October, it turned volatile in November, while DIIs continued buying post Q2 FY26 season's result. So what have been your key takeaways from this season earning?
Q2 earnings season was not up to the mark at the headline level, I would say. When you look at Nifty earnings expectations for the quarter, was expected to be about 6% on a year-on-year basis. It turned out to be about 2%. However, what has been hurting is there was a one-off element which took overall earnings growth down to those levels that I mentioned, which will not be there going forward. And also we are expecting slightly broad-based improvement in terms of earnings trajectory over the next couple of quarters. So we have not seen earnings downgrades at all, despite the fact that there has been slight miss on earnings. So overall, we believe that second half would be better than first half. And also, as I said, financial year 27 would be a year of mid-teens kind of earnings growth in terms of our expectation.
So GST rate cut and strong festive season has definitely given boost to consumption sector. But do you see any further legs to this rally?
Clearly, GST rejig is a structural reform. The GST rates which have come down will stay at those lower rates for a longer period. Right? So to that extent, the uptick that we have seen in consumption, especially in the consumer discretionary segment, should continue over a period of time. However, just after the festive season, we have seen a bit of a let up in terms of consumption trends, but that is natural, I would say, because there was a postponement between August 15th, when the first announcements came about possible GST cut, and the festive season, which started from September 26th, 22nd onwards. So to that extent, there was a bunch up of consumption that happened during the festive period. And we have seen some bit of slowdown post that. But now the wedding season has started for this year. And we do believe that if there is a follow-up buying that will be visible during this season, overall, we continue to believe that over the next few quarters, there is definitely strong consumption trends that we can see.
Policy continuity has been the key argument for market optimism for a few years now. And November's Bihar election results further reinstates this view, right? So, few sectors like infrastructure and industrials are to a large extent dependent on government's policy and spending. How do you see the sector performing from here on?
Surely, these are the sectors which are dependent on how strong the government capex is going. And as far as central government capex is concerned, we have seen a very, very strong rebound in capex numbers for the first half of this financial year. That's largely due to the fact that it was front-ended and also the fact that last year first half was very, very muted. Even if you assume that there is going to be a normalization in the spend over the next few months, you are likely to see 10 to 12% kind of capital expenditure growth as far as central government is concerned, which is a fairly a good growth over the last year, I would say. The order books and the execution timelines for most of these projects are also well in control. So we would expect capital goods and infrastructure sector also to participate in the rally over the next couple of quarters. Only thing is, it may not be as strong as what it was between 2020 and 24, when there was a larger level of spend that was happening. And to that extent, it was more of a uniform kind of a sectoral move. But now on, probably it will be more stock specific.
So IT stocks rallied on buyback news and easing US yields in November. Do you think this trend will sustain, or do you see any leadership shift to any other sector?
We still believe that the business momentum in the IT sector has not changed. Yes, there are some one-off events which have led to a slight uptick in terms of stock prices, and more so because we had seen a very sharp correction in IT sector for the previous few months. But other than that, we really don't see a very large structural positives for the sector. So in our view, IT sector may still remain more or less like a underperformer or a market performer. We really do not see a large amount of outperformance coming from this sector in the near term.
So we know Nifty Bank hit a record high in November. Do you think banking is going to outperform in coming months as well?
Yes, that's been our expectation. We clearly have seen most of the rate cuts panning out in this rate cycle. So the impact on net interest margins would be very limited going forward in our view. And we also expect credit growth to improve, largely led by retail consumption. And the asset quality issues in the sector are also very minimal. So overall, we do believe that the outperformance of banking and financial service sector over the benchmark should continue to pan out even over the next 12 months.
So given November's mix of record highs, FII outflows, and global uncertainty, what would be your suggestion to the investors? Should they stay defensive, buy on dips, or maybe rotate within the themes given as where the market value stands?
As always, we would prefer to suggest a time-tested, systematic investment plan route for retail investors, because that's how you will be able to manage the volatility that could be there in equity markets. And as we know, the valuations have not been so attractive, right? They have corrected over the last 12 months, but it is still at an average level of valuation. So to that extent, there could be ups and downs in the markets. Plus, we discussed about some of the global factors which would also add to volatility. So I think the better idea would be to make systematic investments going forward as well, and keep a tilt towards a little bit of large caps, because that's where there is relatively more valuation comfort as compared to, let's say, small caps. So the portfolio should be tilted towards large caps and maybe a little bit about mid caps and less towards small caps. And the route should be SIP.
Thank you so much, Mr. Harsha, for joining us and sharing your insights on the evolving equity landscape.
Thank you so much.
So that's all for now. And we hope this discussion helps the investors to navigate Indian equities with more clarity and confidence. For more such videos, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.